Imagine opening your bank account. There's your balance. Maybe it looks healthy. Maybe it looks wounded. Maybe it's technically still alive, but one trip to Tesco would finish it off completely. But whatever number is sitting there, we all treat it as money. Real money. You can use it to pay rent, buy food, cover your mortgage, pay your energy bill, or get quietly robbed by a subscription you forgot existed. But here's the strange question. Where did that money actually come from? Most people have a simple picture in their head. Somewhere deep inside the Bank of England, there's a giant money printer. And when Britain needs more money, someone in a suit presses a big red button, the machine starts to go brrr, and fresh cash flies into the economy. Some goes to banks, some goes to businesses, and eventually, after being politely filtered through several people much richer than you, a tiny bit lands in your wages. That is the picture, but it is not really how most money in Britain is created, because most money is not notes, it is not coins, it is not gold in a vault. Most of the money we use is just numbers in bank accounts. And the really odd part is, a lot of those numbers appear when somebody takes out a loan. Not when somebody works, not when somebody saves, not when the government prints it, but when a private bank says, approved. That is the bit nobody really tells you. In modern Britain, money is not just earned into existence, a lot of it is borrowed into existence. The Bank of England says most money in the economy is created by commercial banks when they make loans. When a bank lends, it creates a new deposit. When the loan is repaid, that money is destroyed. And banks are not simply lending out money that savers have already put in. So let's make this painfully simple. Meet Dave. Dave wants to buy a house. The house costs £250,000, which is a normal British amount of money, because apparently a pile of bricks with damp in the corner can now cost the same as a small medieval kingdom. Dave does not have £250,000. Dave has £12,000, a suspiciously optimistic spreadsheet, and a deep emotional attachment to the phrase, "we'll make it work." So Dave goes to the bank and asks for a mortgage. Now, most people imagine the bank doing this. They open a giant vault, they find someone else's savings, they scoop up £250,000 and they hand it to Dave. But that is not what is happening. When the bank approves Dave's mortgage, it creates two things at the same time. On one side, it creates a loan. Dave now owes the bank £250,000. That is an asset for the bank, because Dave has promised to pay it back. But on the other side, the banking system creates a deposit. Someone now has £250,000 in a bank account. Usually once the house purchase completes, that someone is the seller. So Dave gets the house, the seller gets the money, the bank gets a mortgage, and new bank account money has entered the economy. Nobody printed it, nobody dug it out the ground, nobody waited for Dave to earn it first. The bank created spending power by creating debt. That is what people mean when they say loans create deposits. And yes, it sounds fake. It sounds like something a man on Facebook would explain underneath a video of a lizard wearing a crown. But this is not a conspiracy theory, this is just modern banking. A bank deposit is basically the bank's promise to pay you. But because everyone accepts that promise, it functions as money. If I write, "I owe you £10,000 on a napkin," I have created debt. I have not created money. You cannot take a napkin to Asda. You cannot send it to British Gas. You cannot use it to pay your mortgage, although at this point they may admire the creativity. But if a licensed bank creates a £10,000 deposit in your account, that is different. Your card works, the transfer goes through, the seller gets paid, the number moves. That is the privilege banks have. They issue the kind of money most of us actually use. But there is a catch, because this new money is born with a twin: debt. When Dave gets his mortgage, the economy gets new spending power, but Dave gets a 30-year promise wrapped around his neck. Every month, part of his wages go back to the bank. Some of that payment is interest. That becomes income for the bank. But some of it is principal. That is the actual loan being paid down. And when the principal is repaid, the money created by the loan is cancelled out. The debt shrinks, the matching money shrinks. So bank lending can increase the money supply and loan repayment can reduce it. That is the strange engine underneath the economy. New lending adds bank deposits, repayment removes them, which means a large part of Britain's money supply is tied to borrowing. And once you understand that, the question changes. It is not just how much money is there, it is who gets to borrow new money into existence, and what do they get to borrow it for? This is where the system stops being technical and starts becoming political, because banks do not create money evenly. They create money where lending looks safe, profitable and repayable. They like good credit history, they like collateral. And there is one type of collateral Britain is absolutely obsessed with: property. A house is useful to a bank because if the borrower stops paying, the bank has something it can actually claim and sell. That does not mean mortgage lending is risk-free, but compared with lending to a brand new business or someone trying to retrain or a worker with no assets trying to get ahead, property looks solid. So the system becomes very comfortable creating money against houses, and that creates a loop. Banks lend against property, that lending creates deposits, those deposits help buyers bid for property, higher bids push up prices, higher prices justify bigger mortgages, and bigger mortgages allow the next buyer to borrow even more. Round and round it goes. This is why housing is not just a place to live. In Britain, housing became one of the main machines through which credit enters the economy. Now compare two people. One owns assets, the other only has wages. The person with assets can go to the bank and say, lend against this. The bank sees collateral, the bank sees lower risk. The bank is comfortable creating credit around them. That person can use borrowed money to buy another asset, improve a property, expand a business, or avoid selling what they already own. But the person with only wages meets the system differently. They usually receive money after it has entered the economy. They earn it as a salary. Then they use it to pay rent, bills, mortgage payments, car finance, credit cards, childcare, tax, food, energy and interest. One person uses assets to access credit, the other uses future wages to service it. That is why the same debt system can feel completely different depending on where you stand. For the wealthy, debt can be a tool. For the struggling, debt can be a trap. Not because rich people have discovered a magic spell, but because the banking system is more willing to create money around people who already look safe. So this is the uncomfortable bit. Britain tells people that hard work is the route to money. And yes, work matters, but in the background the money system has another route: ownership, collateral, creditworthiness, the ability to walk into a bank and be seen as a good risk. Now this does not mean banks can create infinite money. They cannot. They are limited by regulations, capital requirements, risk, borrower demand, profitability, interest rates, and the need to settle payments with other banks. So this is not as simple as saying banks press a button and get free money. A bad loan can hurt a bank. A borrower can default. House prices can fall. Funding costs can rise. Regulators can tighten rules. The Bank of England can raise interest rates and make borrowing more expensive, but the basic power remains. Private banks create much of the money we use when they lend, and that means the pattern of lending shapes the pattern of the economy. If banks create money to fund productive businesses, new homes, useful technology, better infrastructure, or things that can increase real output, then debt can help create real wealth. But if banks create huge amounts of money mainly to bid up the price of existing assets, then the country can look richer on paper while ordinary people feel poorer in real life. The house is worth more, the landlord is worth more, the bank has a bigger loan book, the seller walks away with a bigger deposit. But the worker now needs a larger mortgage, a bigger deposit, a higher income, or a lifetime of rent payments just to stand in the same place previous generations stood with less debt. That is the money game nobody explains. The point is not that all debt is bad. Without credit, many businesses would never start, many homes would never be bought, many investments would not happen. A growing economy needs some ability to pull future income into the present. But the real question is not simply, should debt exist? The real question is, what kind of debt are we creating and who gets the benefit? Debt that builds useful things can make a country genuinely richer. Debt that mainly inflates the price of things we already own can make some people richer, while everyone else borrows more just to keep up. That is why private debt matters. Not just because people owe money, but because debt is one of the places money comes from. So the next time someone says, just work harder, remember this: work earns money after it exists. Borrowing can create money before it exists. And in Britain, the difference explains more than we like to admit. Private debt is only the first money machine, because there is another type of debt Britain argues about constantly. It's on the news, it's in elections, it is used to justify tax rises, spending cuts and terrifying charts. The national debt. And that one works very differently. Because the national debt is not your mortgage scaled up, it's not a household credit with a Union Jack on it, it is the government's debt. But it is also someone else's asset. And once you understand that, Britain's money arguments start to look very different. But we'll explain that more in the next video.